Silver just experienced one of the most volatile weeks in its modern trading history. And if you're not paying attention to what's happening right now between China and Japan, you could miss the setup for the biggest precious metals move we've seen in decades. Tuesday, February 10th, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. So let's talk about what just happened. Silver prices hit an all-time record of $121 per ounce on January 29th. Just days later, the metal crashed nearly 50%, erasing half its value in what traders are calling one of the most extreme liquidations in commodity market history. As of today, silver is trading around $80 per ounce, rebounding from lows near $76, but still showing the kind of volatility that tells us something fundamental has changed in this market. And here's what you need to understand. This isn't just normal market correction. This is a structural shift happening in real time, driven by two major policy changes that are converging this week. China, which controls between 60 and 70% of global silver refining capacity, is implementing export restrictions that fundamentally alter how silver flows around the world. And simultaneously, Japan just raised interest rates to their highest level in 30 years, unwinding decades of ultra-loose monetary policy in ways that are sending shockwaves through currency markets and precious metals demand. Let me break down exactly what's happening with China first, because this is arguably the most significant supply-side development in the silver market in modern history. Starting January 1st, 2026, China implemented new export controls on silver that require government licenses for any company wanting to export the metal. But here's the critical detail that most people are missing. These aren't just bureaucratic hurdles. The new rules impose a minimum annual production threshold of 80 tons, which effectively consolidates export privileges among state-aligned entities while excluding smaller and mid-sized players entirely. Think about what this means. China doesn't just mine a lot of silver, they control the world's largest silver refining infrastructure. We're talking about a nation that has historically supplied the majority of refined silver that flows to Western industrial markets. The Silver Institute has documented 5 to 6 consecutive years of annual global supply deficits, yet prices remained relatively suppressed because Chinese supply kept injecting metal into the market. Now that injection is being throttled. The numbers tell the story. In 2025 alone, global demand reached 1.24 billion ounces, while supply lagged at 1.01 billion ounces, creating a 230 million ounce shortfall. That's nearly a 20% deficit between what the world needs and what's being produced. And now China is reducing the amount of refined silver leaving their borders at exactly the moment when that deficit is already acute. But why would China do this? This isn't about domestic supply constraints. China's industrial silver demand, particularly for solar photovoltaic cells, has exploded. Solar panel production alone now accounts for 20% of global silver consumption, and China dominates solar manufacturing. The transition from older PERC solar cells to newer N-type designs like TOPCon and HJT cells is driving this even harder. Where PERC cells use about 10 milligrams of silver per watt, TOPCon cells require approximately 13 milligrams, a 30% increase, and HJT cells demand 20 to 22 milligrams per watt. China needs that silver domestically. There's also a strategic dimension here. China has been accumulating substantial undisclosed silver reserves while simultaneously supplying Western industrial demand, essentially building strategic stockpiles while influencing global pricing mechanisms. The export restrictions mirror what China has done with rare earth elements and other critical materials, using commodity exports as diplomatic and economic leverage. When you control the majority of global refining capacity, you can influence markets through policy decisions rather than just economic forces. The immediate market impact has been dramatic. Silver lease rates in London surged to 8 to 9%, levels we haven't seen in years. Physical inventories at major trading hubs have plummeted. COMEX stocks are down 70% since 2020, and Shanghai inventories hit 10-year lows before the recent volatility. During the Thanksgiving period, there was a record movement of 13.4 million ounces from JP Morgan's registered COMEX warehouse pile into the eligible category, suggesting major players were positioning ahead of these restrictions. Now let's talk about Japan, because what's happening there is equally significant, and it's creating a perfect storm when combined with China's moves. On December 19, 2025, the Bank of Japan raised its policy rate by 25 basis points to 0.75%, the highest level since 1995. This might not sound dramatic, but you have to understand the context. Japan had negative interest rates for nearly a decade. Their base rate was near zero from the late 1990s until early 2024. This was the foundation of the famous yen carry trade, where investors borrowed cheaply in yen, converted to other currencies, and invested in higher-yielding assets globally. That trade is now unwinding, and it's pulling liquidity from global markets. Japanese government bond yields have surged. The 10-year yield hit 2.02%, the highest since 1999. The 30-year yield climbed past 3% for the first time in decades. This matters because rising Japanese bond yields make alternative assets less attractive and force portfolio rebalancing globally. But here's where it gets interesting for silver specifically. Japan's weak yen throughout 2025 drove massive investment demand for precious metals among Japanese investors. When your currency is devaluing, you look for stores of value. Japanese gold ETF holdings surged sixfold in 2025 compared to 2024. That same dynamic is now playing out in silver, where Japanese investors are seeking protection against currency erosion, even as the Bank of Japan tries to normalize policy. The political situation adds another layer. Prime Minister Sanae Takaichi won a landslide election victory recently, strengthening expectations for expansionary fiscal policy. She's launched a $135 billion stimulus package, reminiscent of the old Abenomics playbook, designed to boost GDP growth, which contracted in the third quarter of 2025. This creates a contradiction. The Bank of Japan is raising rates to combat inflation that's been running above their 2% target for 44 consecutive months, hitting 2.9% in November. But simultaneously, the government is pursuing massive fiscal expansion that could weaken the yen further and drive more inflation. For precious metals investors, this is bullish either way. If rates rise, it confirms that real inflation is persistent and fiat currencies are losing purchasing power. If the yen weakens despite rate hikes, Japanese investors will accelerate their moves into hard assets. We're already seeing this. Physical gold and silver demand from Japan has been robust throughout this volatility, with Japanese investors treating the recent price drops as buying opportunities rather than reasons to sell. So what happens when you combine China's export restrictions with Japan's monetary policy shift? You get a supply crunch meeting a demand surge. China is restricting the flow of refined silver to global markets at exactly the moment when industrial demand for electronics, solar panels, and electric vehicle components is accelerating. Analysts project annual deficits could exceed 5,000 metric tons if Chinese exports drop by 50%, building on existing shortfalls. Meanwhile, Japan's policy normalization is unwinding one of the largest sources of cheap global liquidity, forcing risk asset repricing and driving safe haven demand. When Japanese investors can't rely on currency stability or government bonds to preserve wealth, they move into tangible assets. The combination means less silver available globally, while more investors chase it. The volatility we just witnessed reflects this structural tension playing out in real time. The spike to $121 per ounce was likely driven by speculative positioning ahead of China's restrictions taking full effect, combined with broader precious metals momentum as gold pushed toward $5,000. When leverage positions got squeezed and margin requirements increased, the sell-off was brutal. U.S. Treasury Secretary Scott Bessent even attributed the extreme swings to Chinese traders, describing it as a speculative blow-off. Let me give you some perspective on where silver could go from current levels. The gold-silver ratio right now is around 64-1, meaning it takes 64 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been much lower during precious metals bull markets. If silver starts outperforming gold as industrial demand accelerates, we could see the ratio compress to 40 or even 30-1. With gold around $5,000, that would put silver anywhere from $125 to $166 per ounce. Some technical analysts who've been following silver for decades have adjusted their targets for the first half of 2026. The breakout above $35, then $40, then $50, established persistent trend strength, typically indicative of significant structural change. Even after this correction, silver remains more than 160% higher than it was a year ago. That kind of move suggests we're in a new price regime, not just a temporary spike. JP Morgan's base and precious metals strategists are forecasting silver prices to rise toward $58 per ounce by the fourth quarter of 2026, averaging $56 for the full year. That's conservative compared to some projections. Other analysts, pointing to the supply crisis and China's export controls, see potential for silver to reach $200 to $300 per ounce within 6 months if the physical shortage becomes acute. Here are the key catalysts to watch. First, how strictly China enforces these export restrictions and whether they tighten them further. If smaller exporters who previously supplied Western markets are truly shut out, the supply shock will be immediate and severe. Second, watch Japan's next interest rate moves. The Bank of Japan has signaled they're not done raising rates. Markets expect another hike could come at their June meeting after this spring's wage negotiations conclude. Each rate increase puts more pressure on the yen carry trade and drives more safe haven demand. Third, monitor COMEX and Shanghai warehouse inventories. If registered stocks continue declining and we see delivery squeezes, that's a signal that paper markets are disconnecting from physical reality. Silver mining equities have already surged 150% in 2025 as investors bet on this supply rigidity. Companies with advanced stage projects and efficient production economics are positioned to benefit massively if these price levels hold. Fourth, watch for any policy shifts from Western governments trying to secure domestic silver supply. The U.S. Department of Defense has already made strategic investments in domestic mining capacity for other critical minerals. If silver shortages start impacting defense or technology sectors, expect government intervention to build domestic refining infrastructure, which would only confirm the severity of the supply problem. The risk factors you need to consider are real. If global economic growth slows significantly, industrial silver demand could soften. If central banks pivot back to tightening instead of the expected easing, that could pressure all commodities short-term. There's also the possibility of alternative materials replacing silver in some applications, though the metal's unique electrical conductivity makes it essentially irreplaceable in most current uses. But the base case scenario for silver over the next 6 to 12 months remains bullish. We have a structural supply deficit that's been years in the making. We have China implementing export controls that reduce global availability. We have Japan's policy shift creating both currency instability and safe haven demand. We have industrial demand from AI, renewables, and electronics that isn't price sensitive because there are no good substitutes. And we have investment demand from both retail buyers and institutions who see precious metals as necessary portfolio diversification in an environment of persistent inflation and geopolitical uncertainty. The volatility is going to continue. This isn't going to be a smooth ride higher. We could see more washouts like we just experienced as leveraged positions get liquidated and momentum traders exit. But for investors focused on the fundamentals, these pullbacks represent buying opportunities before the next leg up. What happened this week with silver dropping from 120 to 75 and then rebounding toward 80 is exactly what happens when a market transitions from one paradigm to another. The old equilibrium where China supplied the West with cheap refined silver while running persistent deficits is breaking down. The new equilibrium hasn't been established yet. That's what creates volatility. That's what creates opportunity. So when you're watching silver prices bounce around these next few weeks, remember what's driving this. It's not just speculation or manipulation or random market noise. It's China fundamentally changing how silver flows globally. It's Japan unwinding decades of monetary policy while simultaneously pursuing fiscal expansion. It's a physical commodity market that's been in deficit for years, finally repricing to reflect scarcity. And it's industrial and investment demand that shows no signs of slowing, even as prices reach levels that would have seemed impossible just 2 years ago. The question isn't whether silver goes higher from here. The fundamentals strongly suggest it will. The question is how volatile the path will be, and whether you have the conviction to hold through the swings. Because what we're witnessing right now, this convergence of China's export restrictions and Japan's policy shift, creating market volatility, this is just the beginning of a much larger structural shift in precious metals markets that's going to play out over the next several years.